Hey everybody, welcome to the Basis Points Podcast. I'm Kevin Flanagan, Head of Fixed Income Strategy at Wisdom Tree Asset Management. Here we are, Fed Watch. We are now at the midway point, and once again, the Fed kept rates unchanged at the June FOMC meeting, so as a result, the Fed funds trading range remains in the 5.25% to 5.5% band that was introduced in July of last year, and that still resides at a more than 20-year high watermark. And for those keeping track, this represents the 7th consecutive FOMC meeting where the policymakers decided to take no action on the rate front. And for calendar year 2024, as I said, we're now hitting the midway point in terms of the number of annual Fed meetings. And despite economic and inflation data that has challenged prior rate cut expectations, Powell and company still seem to agree that a rate cut will more than likely occur sometime later this year. However, what this potential rate cutting episode is going to eventually look like is still up for debate, and that point was underscored by the revision in the Fed's own federal funds rate forecast, known in market parlance as the dot plot. 4 times a year, the policymakers provide their summary of economic projections, SEP, along with their usual FOMC meeting policy statement. And within this SEP lies this aforementioned dot plot. And the June meeting entails an updated forecast. And up until now, the Fed had been projecting 3 rate cuts for this year, but in their revised outlook, that number has now been reduced to 1 easing move, a bit less than money and bond market expectations. But based on recent Fed speak, some reduction was arguably well telegraphed by the policymakers. So now that we have half of the Fed's regularly scheduled FOMC meetings in the books for this year, investors are still left trying to ascertain what exactly Powell and company will do at the remaining 4 policy convocations in 2024. And obviously, the Fed's data dependence remains on full display, and arguably one could characterize it as heightened at this point. And if the Fed is in heightened data dependence mode, that means so is the U.S. Treasury market, and that can elevate the volatility quotient accordingly. Now, presently, monthly inflation reports appear to be the primary driver for Fed policy decision-making, with the labor market data following close behind. And as we've seen, both these inputs have not only provided the Fed with no urgency to consider easing monetary policy anytime soon, but they've also played an integral role behind rate cut expectations being scaled back in such a visible fashion. So here we are. As a result, the voting members apparently feel right now they can just sit back and be patient, as that last mile towards their 2% inflation goal has proven to be a bit more challenging than initially envisioned. Now, in my opinion, renewed consistent progress on inflation is a necessary ingredient to getting the Fed to feel comfortable enough to begin this rate-cutting process. In addition, unless the labor market shows signs of falling off the cliff, the course of monetary policy easing could be a choppy one, as Powell and company await fresh data for the next move, and that could mean rate cuts may not come with each subsequent FOMC meeting. So the bottom line at this point, I believe 2 rate cuts is still a reasonable case scenario for 2024. However, don't be surprised when the Treasury market begins to entertain the prospects for 2025 monetary policy. So that's it from me. I'm going to close it out on another Fed day here in the month of June. Have a great rest of the week, everybody, and be well.